Hello, I'm David Buckland. The global economic environment, according to consensus, will deteriorate as 2023 progresses. And in this week's video insight, I want to focus on the behavioural science of investment markets. As economies slow, the secondary effects will see many companies cutting their cost base by retrenching staff as the economic narrative shifts from peak inflation to recession. The excess is brought about from central banks allowing official cash rates to approximate nil over 2020 and 2021 saw many investors lulled into a false sense of security and often, in hindsight, paid elevated prices as an alternative to the nil-yielding cash. As the central banks have rammed up their official cash rates over the past 12 months, with possibly one or two more tightenings to come, those excesses came to an end last year. We're seeing this in Australia, particularly with a number of builders going into administration. Recent examples include ProBuild, Condev, Pivotal Homes, Pindan Group, Snowden Developments, Oracle Platinum Homes, Firm Constructions and EQ Constructions, to name a few. The 2022 year saw a surprisingly high correlation between different asset classes. The substantial increase in official cash rates placed varying degrees of pressure on the valuation of those companies with no earnings, those growth companies, government bonds, residential property and commercial property. And in some cases, there is still further downside over the foreseeable future. That said, risk is not necessarily inherent in an investment. It is always relative to the price you pay. For example, over the 18-month period of the global financial crisis between September 2007 and March 2009, many share markets halved. And many individual companies' share prices did much worse than that. Clearly, purchasing investments post the dramatic drawdown when opportunities were unloved or out of favour is much less risky. Conservative positioning enables investors to take a long-term, broad and flexible approach, to be clear thinking and to focus on those unloved opportunities. An important starting point is to be cautious around leverage, as capital markets can be extremely fickle. Leverage, particularly in combination with an economic slowdown, can drive dramatic price and valuation swings, as witnessed by the troubled Australian builders. And because governments are typically elected every 3 to 4 years, they cannot withstand a lot of pain in the economy or the financial markets. However, predicting the timing and benefit of any particular bailout or rescue is impossible. Investors who are trying to build up a solid nest egg need to think long term, need to take a conservative approach, and need to be nimble when lower risk opportunities are compelling. That's all we have time for this week. Thanks for watching, and please don't forget to follow us on Facebook and Twitter.